Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr law firm. And I'm your host, Alan Kaplinsky, the founder and former practice group leader for 25 years, and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I will be moderating today's program. For those of you who want even more information, either about the topic that we'll be discussing today, or for that matter, anything else in the world of consumer financial services, don't forget our blog, which is called Consumer Finance Monitor. That's the very same name as our weekly podcast show. We've hosted our blog since 2011, when the Consumer Financial Protection Bureau became operational, and there's a lot of relevant industry content there. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspar.com. And if you like our podcast show, please let us know about it. You can leave us a review on whatever platform to access your podcast show. And also, if you have any ideas for other topics that we ought to be exploring or other speakers that we should consider inviting, please let us know about that. We really do appreciate it. So let me tell you a little bit about what we're going to be covering today. And this is a topic that I think will resonate with a lot of our listeners because a lot of our listeners are banking institutions or officers or employees of banks, and they have been experiencing what has been going on now for about 8 months. We're going to be giving you an overview of the deregulatory developments that have occurred under the Trump administration, which we can refer to as Trump 2.0, since January 20th. President Trump was sworn into office up to where we are today. So, since taking office on January 20th, the Trump administration has pursued a very aggressive deregulatory agenda in banking, emphasizing reduced supervisory burdens, streamlined examinations, and curtailed actions, sometimes enforcement actions, that are perceived as being an overreach. This really aligns with the administration's so-called 10-to-1 initiative, aiming to eliminate 10 regulations for every new one issued, and executive directives that are prioritizing economic growth over expansive oversight. The key agencies that we'll be focusing on today will be principally the FDIC, the Comptroller of the Currency, the Federal Reserve Board, and to a lesser extent, the CFPB. Each one of them has seen leadership changes favoring deregulation, leading to withdrawn proposals, restructured supervision frameworks, and narrowed exam scopes. During our podcast show today, we will provide you with specific examples that things that have happened that focus on supervision, examinations, and enforcements and regulation. These developments signal a shift, you could almost say a 180 shift, toward tailored regulations, prioritizing core financial risks while de-emphasizing non-financial or what's sometimes referred to as reputational factors. Okay, I'm going to introduce our honored guest today. We have one outside guest, and then we have one person who's really not a guest to the show because he is a partner at Ballard Spahr. So first of all, our outside guest, Sean Campbell. He's the chief economist and the head of policy research at the Financial Services Forum. And he's had that role since April 2018. He's going to tell you very soon what the Financial Services Forum is all about. Prior to joining the forum, Dr. Campbell served as an associate director in the Federal Reserve Board's Division of Supervision and Regulation and as deputy associate director in the Division of Research and Statistics. He joined the Federal Reserve Board staff as an economist in June 2004. While at the Fed, Dr. Campbell contributed to the development and design of an array of regulatory policy initiatives regarding stress testing, capital, derivative markets, and a number of Dodd-Frank Act reforms. Dodd-Frank Act, of course, was enacted in July of 2010. Dr. Campbell's research focuses on financial risk management and the intersection between the macroeconomy and financial markets. His research has been published in a number of leading peer-reviewed academic journals, including the Review of Financial Studies, the Journal of Financial and Quantitative Analysis, and the Journal of Business and Economic Statistics. Prior to joining the staff of the Fed, Dr. Campbell was an assistant professor of economics at Brown University. He has a PhD in economics from my alma mater, University of Pennsylvania, and a BA in economics from the University of Massachusetts, where he graduated Phi Beta Kappa. So, with that, I want to give you a very warm welcome, Dr. Campbell, and if you don't mind, I'm going to call you Sean during this podcast. So, welcome to our show.
Thank you very much for having me. Pleased to be here.
Great. Now let me introduce to you my Ballard Spahr partner, who heads up what I would call our bank regulatory and transactional practice, which intersects quite a bit with our consumer financial services practice, and that is Scott Coleman. For 30 years, Scott has represented banks and bank holding companies in connection with mergers, stock purchase transactions, branch purchase and assumption transactions, capital raising, corporate restructuring, branching, non-bank acquisitions, changes in bank control, and charter conversions. There's really nothing that Scott hasn't done during his lengthy career pertaining to bank regulations, bank structure, bank supervision, bank enforcement. So, Scott, a very warm welcome to you.
Thank you, Alan. Very happy to be here.
Okay, let's get into it. So, Sean, why don't you start by telling our members what exactly is the Financial Services Forum?
Sure. So, very briefly, the Financial Services Forum is a trade association here in Washington, D.C., and our members are the 8 global systemically important banks that are headquartered in the United States. So, globally, regulators have identified roughly 30 such banks all around the globe, and these are your leading global banks. Again, roughly 30 of them around the globe, and the 8 that are headquartered in the U.S. are our members here at the Financial Services Forum. So we're a trade association, and at least in my role as chief economist here at the forum, I primarily do, broadly speaking, 2 different things. One is to help the world better understand the value that our members bring to the economy, whether that's through traditional lending and deposit-taking activities, including sort of consumer lending, or whether that's through supporting deep and liquid financial markets in service of the asset management industry, or helping people to save for their future retirement, or through wealth management products that they provide. just trying to help people sort of understand what it is our members do for the broader economy. And then the second aspect of what we do here at the forum and what I spend my time doing is working with the folks in Washington, regulators, folks on Capitol Hill, essentially to help them understand sort of the regulatory framework that our members face and the sort of the constraints and the bottlenecks and some of the issues that arise as they try and comply with those requirements, and to sort of help other policymakers, kind of see issues that our members feel are important to them and are more broadly important to the economy as they think about, how to comply with and how to structure a kind of reasonable and sensible regulatory regime.
Right. Okay, thank you. So, Sean, as I indicated during my introductory remarks, it seems that the current Trump administration has been very receptive to the members' regulatory reform priorities. Could you briefly walk us through what those priorities are and the outlook?
Sure, happy to do that. I would say at a very high level, I would just take a step back and think a little bit about where we are in 2025 and kind of how we got here. And I think that actually helps to understand sort of the current policy trajectory. So, 15 or more years ago, we had a financial crisis in the U.S., a very deep financial crisis, which was costly to the economy and to a lot of Americans. And post that financial crisis, there was a regulatory initiative to substantially and significantly change sort of the financial regulatory framework, especially as it applies to large banks. That got completed over let's call it a 3 or 4 year period. And since that period of time, that regulatory environment has persisted for, let's call it 15 years. And I think, from my perspective as an economist, when you think about a policy change as an economist, the first thing you think about once you've made a policy change is you want to sort of collect data and you want to understand whether or not that policy change is achieving the intended goal. And you want to sort of make that assessment in some sort of data-based way. And, our members and more broadly here at the forum, we have been thinking about that at least since I've been here for the past 8 years, but even before then. And we think a lot of sort of information and data has kind of accreted over time that does suggest that certain elements of the regulatory framework aren't really achieving their intended goal and sort of aren't serving the desired purpose, and in some respects are sort of holding back the broader economy. We've been making that case for a number of years, and it is very much the case that the current administration seems to be somewhat more receptive to that point of view. And there have been changes made at each of the key regulators that you discussed at the opening of the podcast here, whether that be the Fed or the OCC or the FDIC. And those folks are more seriously sort of looking backwards into the recent history, in essentially asking a fundamental question, which is, what is the state of the regulatory system that we have today for large banks? Does it make sense given recent experience and sort of given the structure of the U.S. economy and the financial system as we have it now? So that's kind of that's the background. And in terms of the reform efforts, I would say broadly speaking, there are two sets of reforms that are ongoing. One is reform of the large bank capital framework, which again is a product effectively of post-financial crisis reform that happened, circa 2010, 2012, somewhere in that period. And again, data, information, experience has crept up over time that leads one to question whether that framework is really working as intended. And I think there are some efforts afoot to modernize, if you will, and improve the regulatory framework in a way that will ultimately benefit the entire economy. And then the second large sort of prong or bucket of reforms relates to the supervisory process. So unlike the regulatory process, which for the most part is relatively transparent and kind of out in the open, anybody who wants to, for the most part, can go see a banking regulation and read all about it and understand exactly what a bank has to comply with. Supervision is by its very nature somewhat more, it's just less transparent, and it's different, more difficult to peer inside and understand exactly how supervision is working. But there's an effort in the context of supervision to also sort of what I would say modernize and streamline and improve supervision by focusing it and anchoring it, much more directly to issues that are directly relevant for thinking about sort of core and material risks that are important for safeguarding safety and soundness, and sort of de-emphasizing or shifting resources away from supervisory oversight activities which are not directly focused on material risk and safety and soundness.
Okay. Let's drill down on the stress testing. And the Fed voted very recently to make a change in stress testing. What exactly are they proposing to change?
Sure. So there's actually a lot there to unpack. So let me just give what I think is a good sort of high level thumbnail. So I think the most important change that the board is making in the stress testing reform package is making public and transparent for the first time in 15 years the sort of the specification and the details around the models that are used to determine each and every year effectively the capital adequacy of large banks, and which has a direct influence on the amount of capital that regulators require that those large banks maintain. And so, again, for historical context, before the financial crisis, we did not have a stress testing regime in the United States, at least not a systematic and regular one. We had a financial crisis. And as I'm sure many of your listeners will remember, the stress tests were implemented during the financial crisis really as a means of providing a public signal, the health and safety of the banking system, and identifying those banks that were in the greatest need of a capital infusion. And that was done, and I think it was largely viewed as a success. And then after that period in time, the stress test became an annual part of sort of the capital adequacy assessment cycle by the regulators. But from time immemorial, from the period of 2010 on forwards, the models used by regulators to determine whether a given bank had enough capital or too little capital were something only known inside the inner sanctum of the Federal Reserve. Other regulators did not know what was inside those tests, how they were put together, how the sausage was made, however you want to say it. And that is completely at odds with every other aspect of capital regulation and indeed bank regulation, and really regulation writ large in the US, which is to say, if you're a regulated entity and you're subject to a capital requirement or you're subject to, an activity restriction or whatever it might be, you sort of have an expectation that you'll know what is that regulation, how is it put together, what are the rules that I'm subject to, and you'll be able to analyze that. The stress tests really were a break from that standard sort of operating procedure, good government, sunshine is the best disinfectant approach to government, which we normally practice in the US. And it was just kept secret. And there were a variety of reasons why the regulators thought that was a good idea, but it was broadly just at odds with basic notions of transparency and good government. And the main thing that the Federal Reserve is doing is basically kind of putting those models out in the sunshine for a whole variety of people to look at and to kick the tires on. So that'll be people in academia, academics, modelers, people in the banking sector. So I would say that's the most important change that we're seeing as a result of this proposal. And then, I would say further down the list, the Fed is proposing some changes to those models in light of their experience, over the past, whatever it might be, 10 years or so, that they think would better approximate sort of what's going on inside the banks. And those are some sort of very technical, changes to those models that are probably important, but in the grand scheme of things, probably a little bit less important from a public policy perspective than the significant sort of improvement in transparency that will come about as a result of this proposal.
So some people who've been critical of this change, making it stress testing more transparent, have said it's like providing someone answers to a test. I assume you disagree with that viewpoint.
Yeah, good guess. And we do disagree with that viewpoint. And I say that as somebody who actually also, I do a little bit of teaching, I guess, on the side. And so I'm well familiar with that analogy. And I don't think it's apt in the current circumstance for a variety of reasons. I have a different analogy in mind, which is if you drive a car and you're driving down the highway or some road and the speed limit is not posted, and you get pulled over by the police, and they say, hey, you were speeding, so you have a ticket for $100. And you might say to the police officer, okay, well, I guess I was speeding and I'll take your word for it, but there's no speed limit. So how am I supposed to know how fast I should be driving? And one way you can think about a capital rule is the regulator's sort of public statement about how risky they think certain assets are. How risky is a loan to a small corporation? How risky is a loan to a sovereign government? How risky is a loan to a consumer that's purchasing an automobile? What have you. And it's a very public statement about the risk profile of that asset. And if the bank wants to engage in that kind of lending, how much capital should they maintain to guard against the risk that they suffer some losses from making those loans? Well, again, previous to the financial crisis, banks had full information about what the regulator's statement was about the risk of those assets, and they made choices, in consideration of what those risks were. And in the context of the speed limit analogy, that's like posting the speed limit. And if you see the speed limit is 55 and you're going 65 and you see you cross a 55 mile an hour speed limit, you decide to put your foot on the brake. We don't think of that as cheating or getting the answers to the test or engaging in some nefarious activity. We think about that as that's actually taking a positive risk management decision to control your risk. And that's what banks do. And they use a variety of inputs to make those risk management decisions, their own assessment of the risk of a particular asset category, but also that's complemented by a regulator's view on what the risk of that asset is. And when they make those choices and when they sort of allocate the capital inside the firm, again, we generally consider that to be good risk management and not, cheating on the test or some other thing like that. So that's how I tend to think about it.
Okay. Let's talk about, very briefly, the Basel capital requirements. Members of your association have pushed back on Federal Reserve Board Governor Barr's proposal quite forcefully. Can you briefly explain what that proposal is all about in its previous form, what it would have meant to U.S., we call them GSIBs, or you mentioned what that stands for before, and what you're hoping to see in a proposal now?
Sure. So again, this goes back to our earlier conversation, which is after the financial crisis, there was sort of a torrent of activity to re-regulate the large banking system. And one of the big initiatives that came out of that effort, which was global in scope, was the so-called Basel III initiative. And Basel III really was a sea change in the capital requirements that large banks faced, both in terms of sort of the quality of capital that they needed to maintain, but also the quantity of capital that they needed to maintain. And that capital initiative unfolded, what I would say over a variety of years. It was a big project. And the Basel III sort of endgame sort of proposal that everybody's been talking about for the last couple of years really was the capstone to that entire project. So Basel III went along. There were a variety of things that were implemented in the U.S. It had a variety of pieces. And then there was sort of, if you will, the golden spike in the railroad to finish the project. That was Basel III endgame. And that really was, for the most part, what I would broadly refer to as final cleanup edits. Okay, so like if you've ever written a document or whatever, a report or a legal brief, you kind of get it done, but then at the end you have to go through it, and there are always these little twists and wiggles and little fly speck things that you need to be fixing up. That was broadly speaking what Basel III Endgame was aimed at, and in particular, when the people in Basel came out with it, they indicated publicly that this was not really an effort to raise capital in the banking industry. They had already achieved that through the rest of Basel III. This was really a dotting I and crossing T exercise. And that got done in 2017 by this group of international regulators known as the Basel Committee. And it kind of sat around, and for a variety of reasons, inertia being a big one, it just didn't get acted on by regulators either in the US or internationally. And then there was a push a couple of years ago to get it done. And that's the context in which Michael Barr floated the proposal for Basel III Endgame in the US. And out of the gate, when the proposal was floated by the Federal Reserve, I guess back in 2023, the bottom line impact of that proposal would have been to increase capital for large banks like our members by something like 25%. And our assessment of that was, not only is that wholly unnecessary given the significant capital buffers that our members already maintain and their significant capital strength, it's not even consistent with what Basel III Endgame was designed to be in the first place. And indeed, if you looked at the way that Basel III Endgame was being implemented either in Europe, on the continent, or in the UK, the signals were that was going to have an impact in those jurisdictions on capital of low single digits at most. But in the US, it was coming up with a 25% increase. And so we just thought that was right out of the gate, just not compatible either with the capital situation in the US for large banks, such as our members at the forum, or the sort of, underlying rationale or motivation for Basel III Endgame in the beginning. So that's why it was, pushed back against so strongly by our members. But I would also add, if you look into the historical record, there were lots and lots of sort of people interested in public policy who thought that there were problems with the Basel III Endgame. And that goes to everybody from the Urban Institute, NAACP. There were a variety of stakeholders that thought that in many ways the capital rule was going too far and was going to put too much downforce on lending in the U.S. economy, whether that be for mortgages or business loans or credit card loans or what have you. So that's where Basel III Endgame sort of shook out with the regulators a couple of years ago. And, as you mentioned, we've got a new cast of regulators at the Fed and the other regulatory agencies now. And we're very much looking forward to, in anticipation of a new proposal for Basel III Endgame. And our expectation is that it will be much more consistent with the original goal of the actual sort of global Basel III Endgame proposal, which would be, again, a kind of an I-dotting, T-crossing exercise that does not have the impact of necessarily or at all raising capital by, say, 25%.
Right. All right, let's shift now to really a different subject, but a subject that's extremely important to banks, particularly those that are engaging in M&A transactions or other significant transactions, because if they're not careful about the Community Reinvestment Act or CRA, these transactions can be disapproved, or the time for getting them approved can take much longer. So during the Biden administration, there was really a total overhaul that was completed of the Community Reinvestment Act, changing a lot of things. And now it seems to be a completely dead letter. What do you think, Scott? Well, I'm going to ask Scott this question first, and then we'll go to you, Sean. What do you think about CRA reform? Do you think it should be revisited, or do you think the existing old rule ought to just remain in effect?
I think for the most part, the old rule was fine, and I don't think there was really an imperative to change it. And the way that it was changed so dramatically was going to create a tremendous compliance burdens. I do think the rule was last amended in 1995. Banking has changed dramatically. And I think the one thing that probably does deserve revisiting, although I don't know if it's going to happen, is the determination of assessment areas. Community Reinvestment Act focuses on assessment areas that are basically geographically determined by where you have your main office, your branches, and deposit-taking ATMs. And so that doesn't really connect to how people carry out banking on their phone from anywhere using apps. And so that is something I still think maybe deserves attention. I don't know if Dr. Campbell has any insight to whether that will happen or not.
Yeah, I'd like to know what you think, Sean, whether that will happen, because I at least I always worry whenever you open up a subject, sometimes you may have a very narrow objective, but there are a lot of cooks get involved, and you end up with something that doesn't look exactly like what you wanted. So anyway, what is your reaction to that?
So my first reaction, just to be totally candid with you folks, is that's not a policy area. That's what I would call sort of part of my day-to-day daily bread. I have some passing familiarity with the issue, and I know it's important to a variety of our members, about half of them. The one thing that I would respond to is I think it's absolutely correct to say that the last time the CRA was updated was 1995. Of course, I'm old enough to remember what 1995 was really like in terms of our daily lives. And if you think about what 1995 was versus 2025, we're sort of on a different planet today, and that is very much reflected in the banking sector. Those points were already made. The rise of internet banking. I mean, I'll be totally frank. Look, I sort of work in the banking industry, and I'm kind of knowledgeable about the banking industry, and I rely on my bank for a lot of things. I don't think I've stepped into a physical bank branch in probably I think I had to do it once or twice during COVID for some random reason. And I think I'm representative of a lot of people out there. Not everybody, but there are a lot of people like me. And so I think there has to be some reckoning of CRA and the underlying rationale of CRA with this notion of the assessment area. I do think that's a big deal. Technology has moved really fast in the last 20 years, and regulation has never moved as fast as technology. And then in terms of like whether it's going to get done, frankly, although I love to prognosticate in general, when it comes to predicting what regulators will and won't do, I try and shy away from that because I find that to be you're bound to be wrong when you make such forecasts. So I just don't know.
It doesn't seem, at least to me, from my viewpoint, I don't know if you disagree, Scott, that this is a priority right now, that there's a lot of focus being given to CRA. Instead, the focus is just deregulation. Do you agree with that?
I do agree. I think that's accurate. Based on what we're hearing, there is no agenda to address CRA that's presently before the agencies.
Right. Well, let's now turn to what is definitely before the agencies. And that's the question of the scope of supervision, which includes, most significantly, the scope of bank examinations. So, Sean, turning to that subject, the forum has pushed for reforms to the supervisory process, as a number of other trade associations have and bankers have. Can you tell us more about what is it that the forum is seeking and why it matters?
Sure. Again, at a high level, I would say a couple of things about that. So the first is that sort of robust oversight of the banking sector vis-a-vis supervisory authority. Okay, that's important. And again, sometimes people talk about these things as though, they are extremely technical and hard to understand. And I don't really take that position. So, in the context of supervision, there's a role for government to be ensuring that regulated entities are complying with the regulations to which they're subject. And there's also a role to ensure that those entities are acting in a safe and sound manner that is going to ultimately support the economy. Just like, we have regulation and supervision of lots of other sectors. I don't know, like say meatpacking or the building of automobiles. We want to make sure when a car rolls off the assembly line, it's built to the right standards, and it's gonna protect somebody, in the case of a car crash. And when meat rolls out of the plant in Iowa somewhere, we want to make sure that somebody's going to eat it and they're going to have a great meal and they're not going to end up getting sick. So those are reasonable things. At the same time, again, to go back to the analogy, we think it's really critical that supervision be laser focused on thinking about issues that are relevant to basically safety and soundness and risk in the banking system, and that supervisors are spending sort of the finite and precious resources that they have, focusing on those things that might actually be relevant for the running of a bank. And from the perspective of our members, just thinking about the long arc of where we've come from since the financial crisis, over time there has been an increased sort of focus that has kind of built up sort of bit by bit over time, which often happens in large systems, of being attuned to issues that are not directly relevant for safety and soundness of the banking system. And one way to think about that, or at least one way I think about that, is again, post-financial crisis, we massively increased the amount of capital and we massively increased the amount of liquidity that large banks in particular have to maintain on an ongoing basis. And so, that means from the supervisory community, if there were concerns that a supervisor may have had in, 2006 or 2004 or 1998 or whatever it might have been, the scope for that was somewhat greater because the requirements were just lower. And so if the requirements are lower, the chances are that you run into a bank that's maybe operating just with its, just a little bit above average or something, and kind of you need to be thinking about that as a lot greater. When you double the amount of capital and liquidity in the system, double or triple it, those concerns, for the most part, they just become significantly less significant. And so, every job expands to fill the time that you give it. And so you need to find something to be thinking about. And so you start thinking about other things. And, broadly speaking, in the bank supervisory arena, this kind of residual category of other things we might broadly refer to as what's commonly sort of referred to as quote unquote governance and controls. And, that goes to sort of the broad governance process, at a bank. And again, there are issues related to governance and control, which are totally legitimate. But I think the general view is that the weight and scope of issues related to that set of things grew a lot faster over time and started to focus on things that really just did not have a direct bearing on safety and soundness. And I think just one data point to bring to the conversation, which I think is helpful, is, if we think about recent events, so in particular, the collapse of Silicon Valley Bank. So that happened just a couple of years ago, and that was a relatively significant bank failure in the United States. And the Fed actually did a postmortem analysis of what happened in Silicon Valley Bank. And, Silicon Valley Bank was sort of understood by the Fed to have certain supervisory problems. And if you go back and you look at the list of things that the Federal Reserve was chasing Silicon Valley Bank to be fixing and to be looking at that point in time, they weren't really things that were related to some of the real sort of fundamental features that brought down Silicon Valley Bank, like extreme concentration of liquidity, extreme concentration of depositors, but lack of control of interest rate risk. There were a lot of these governance and controls findings. And so if I just look at the report that they themselves put out, they have a table where they show all the things that they were effectively demanding Silicon Valley Bank to sort of get on the stick and fix quickly. And a lot of those issues were things like, I'll just read off a few of them: data governance, data protection, vendor management, IT asset management, identity access management, third-party risk management governance and risk identification. And I think those things, while in and of themselves, they're not irrelevant, they're just not the kind of thing that go to whether or not a bank is going to open up for business the next day. And that there's just been such a focus on those things that there are two problems with that. One is it distracts the supervisors from the things that they really need to be looking at. And the second thing is that, banks have finite resources too, and they need to basically put time, energy, resources, and a certain amount of calorie burn behind all those things. And if they're doing that, there are other things that they're not doing at the very same time because, all resources are finite. And so improving supervision along the lines of really focusing more significantly on core financial risks, we think are going to have a variety of added benefits. But sort of chiefly, it's going to focus regulators on those things that really matter for the fundamental stability of the banking system. And it's going to improve the efficiency of supervision and the efficiency of the banking system because less time will be spent on issues which are largely peripheral.
Right. So I guess to put it in a simplistic way, as some people have put it, you're advocating getting away from the check the box mentality. The mentality that bank supervisors often have, that they have a list of all things that they need to look at, and it's sort of not seeing the forest through the trees. They're so focused on minutia that they may miss some major risk, like interest rate risk. How the bank is, what kind of investments it's making. Is there enough liquidity to handle a run on deposits? If I got that right, that's basically, what's going on.
That's 100% correct. And actually, your check the box analogy is really important because it brings to the foreground something that's actually part of the problem and critically important, which is to say, when we think about those things that are principally relevant for safety and soundness, so capital, liquidity, asset quality, those are things that banks and supervisors have been quantitatively and rigorously measuring for at least like 100 years or more. We know how to assess a bank's capital. We know how to assess their liquidity. We know how to take a look at asset quality. Those are things that are measurable, that reasonable people, we just can't disagree about how much capital a given bank has or how much liquidity it has. When you get into these other peripheral areas, by their very nature, they are hard to quantify and hard to parameterize in a way that everybody agrees to. So in a situation like that, you set up these check-the-box systems because you can't really come to an agreement as to whether or not the firm's third-party risk management is good or not because it's just multidimensional and it's not people don't agree and it's just too hard. It's hard to measure. So what do? We create a check-the-box thing and then we check all the boxes and good to go. And I think that analogy or that characterization of the check-the-box system really speaks volumes about principally what the problem is.
Yeah. Let me commend to our listeners another podcast that I did much earlier this year, may have even been, no, I guess it was toward the beginning of this year, where I interviewed Raj Date. He used to be, at one time, he He was a very senior member of the CFPB. He was an acting director for some period of time. And he wrote a very interesting short article in a online publication called Open Banker. And basically, he hit on all the points that you've been making, Sean. So let's turn to this topic of reputation risk. That used to be until really through the Biden administration, that was the holy grail, right? Bank safety and soundness has been there forever. But whenever a bank regulator couldn't really shoehorn a problem into the safety and soundness bucket, they always had the reputational risk bucket to use. And they did it quite frequently. That's how they ended up making sure that the banks got out of the business of making payday loans to consumers. It was very profitable making payday loans. It was good from a safety and soundness standpoint, but reputation risk, that was the boogeyman. So what's your thinking about that, Sean?
Look, so I think very clearly policymakers, both at the regulators and I think even folks of Capitol Hill, have expressed a view that reputational risk is just something that should not be present as a factor of consideration in assessing the safety and soundness of the bank. For a lot of the reasons that you mentioned. And I think our members are, broadly supportive of that point. And again, when they make a loan, when they extend credit, what do they want to think about? They want to think about the fundamental risk drivers that determine whether or not that's a good loan or whatever, a good extension of credit. And that's really what their business is focused on. So, the efforts to effectively remove reputational risk as a factor of consideration in the supervisory process, we think is a positive one.
Right. So, Scott, let me ask you, what other changes in supervision have you noted? And I guess I might add that most of your banking clients are community banks located not only in Minnesota, Minneapolis, which is where you practice out of, but in a number of states throughout the country. What are you seeing there, Scott?
Yeah, we're seeing a number of changes, some of which are related to the same things that the globally significant institutions are seeing. One of the areas that we saw, especially in the last administration, was the OCC heightened standards and the necessity that, for example, a large bank's minutes had to show an active and engaged board credibly challenging management. And the question is, that's process, right? And are we focused on process, or were we focused on the underlying results of the institution? And do we really care how they got there, as long as they're well capitalized, well managed, asset quality is good, capital's good, liquidity is good? And we're seeing that trickle down. We've seen some specific actions that are taken and are expected to be taken, including the CFPB's changes with respect to the overdraft fee rule. We've seen the pronouncements about the elimination of the use of matters requiring attention in the exam process. And we've seen the announcement that we're expecting for the smaller banks a change in perhaps a reduction in the community bank leverage ratio. The community bank leverage ratio is currently 9%. It was dropped to 8% in the pandemic. There's some thought that it might be dropped again. It doesn't change the definitions of well capitalized, but it allows smaller institutions to adopt that ratio and not have to also risk weight their assets and report their risk-based capital ratio and comply with that. There's some exam tailoring changes we're expecting to see for smaller financial institutions. The regulators have recently announced elimination of the focus on climate in the examination process. So I think we'll continue to see more of this.
Right. So let's now turn to the one area where I wouldn't call it deregulation. It's really a type of new regulation. And what I'm referring to is an executive order that was issued by President Trump, I think it was early in August, pertaining to debanking or fair access. There's been a lot of attention focused on that by the president, but that's filtered down very quickly to all the banking prudential agencies, the Fed, the Comptroller, the FDIC, and it's played out sometimes, or at least some of the focus has been on crypto companies. And basically, what this executive order is all about is that will not be allowed to make independent judgments completely on who they bank. And by who they bank, I mean who they make loans to, who they decide to allow them, various companies to open up checking accounts or to offer various kinds of payment services. If the bank has done something for political reasons or because of the religion of maybe the owner or the management of a particular company, if it's just decided that it doesn't want to do business with certain kinds of companies like crypto, it could be, or cannabis might be another area, gun retailers and manufacturers are now being told that number one, they're going to have to go back and do a retroactive review. It's very unclear what the scope of that review needs to be and how far back you have to go. But there is a lot of concern out there in the industry as to what are the regulators really going to require. So what I'd like to know first, Sean, is I noticed that some of the bank trade associations, when that first got announced, surprisingly, at least the way I looked at it, applauded that initiative and thought it was a good thing. That's not personally my point of view. I don't like the idea of the government directing banks as to exactly how they should conduct business, as long as they are not discriminating and violating the Equal Credit Opportunity Act and the Fair Housing Act. But some of the bank trades immediately applauded that executive order. What did the forum do, if anything?
So I'll be straight with you. I don't quite recall exactly what we said on that particular issue at this time. I do have some general recollection of that. My recollection is that the general view was to the extent that is effectively saying that you shouldn't be making credit decisions based on somebody's political affiliation or anything like that. That is something to be lauded. And again, banks want to specifically be thinking about the underlying credit risk of the credit extension or the loan, in not what is the person's political or religious affiliation or anything like that. So to the extent that it's making clear that that's kind of not what you should be doing or not acceptable, I think that is something. I don't recall exactly if we put out a statement at that point in time or what exactly that statement was.
Yeah. I mean, one of the problems that I have with the whole thing, putting aside policy issues, I don't think there is statutory authority for what they're doing. The Equal Credit Opportunity Act prohibits discrimination against certain protected classes, and the classes are based on race, marital status, age, and a variety of other factors. It doesn't say anything about politics, doesn't say anything about religion as such, and it doesn't focus on types of businesses that you're engaged in. I'd like to turn to you, Scott, and see what has the reaction been among the community banks that you represent. Are they concerned about this? If so, what are the concerns? And let me leave it at that. And I'd like to get your reaction.
I think there's some modest concern, but there's some deep appreciation for the fact that, and this is related to some of the conversation we've had about reputation risk, right? There was strong opposition to regulators coming in and saying, you can't criticize me because I do business with a particular industry because it's going to have a potentially negative reputational impact. I'm a banker. I want to look at what they're doing, what their financial situation is, And if they meet our standards, credit underwriting or otherwise, they're entitled to service. And I don't want a regulator saying, don't service this industry. So, the fact that they can't debank someone for that reason, I think they're happy with that development. On the other hand, there is some concern about the SBA's request for certification and even the community bank form that has been prepared for institutions below 30 billion in total assets that talk about what you have to do from an examination standpoint and what you have to do from a remediation standpoint to determine whether or not you debank someone. And the related issue, which may have some ties to the development of digital assets and crypto activities, is we need to be clear that some institutions may be deciding not to offer service on BSA AML grounds or on their own compliance infrastructure grounds, where we may say, oh, there's too much money moving in and out for our know your customer compliance rules. And we want to make legitimate decisions, because the one thing that the debanking order does make clear is that BSA AML requirements are still in place. So I think, in summary, appreciation for the move to take the quality of the customer from a conduct or reputation standpoint away from the exam process, but concern about how it's going to be implemented.
Yeah. And I guess you mentioned SBA, Small Business Administration, and I should have, in listing, the regulators that are focused on that, SBA is probably further ahead than the Fed, the FDIC, and the comptroller, at least so far. We're expecting Treasury to issue something, either a regulation or some guidance. That hasn't happened yet. And I don't know what's going to be contained in that.
Yeah, that's correct. The SBA has been out in front in this, and the prudential regulators have said that they will take care of it in the examination process. And so, in theory, for a lot of institutions that are SBA lenders, they will have already done some analysis, developed some infrastructure around responding that the regulators can come in. So we're hoping that from a OCC, Federal Reserve, and FDIC examination perspective, that it's not a big issue.
Yeah. I will say, though, it's got the industry, at least the banks that I'm dealing with, they've got lots of questions, and we're trying to guide them through what they need to do to prepare. Because at some point, I would expect regulators will come knocking on the doors of a lot of our clients, and they want to know, what have they done in the past to ensure they haven't been debanking anybody. And there are all kinds of questions. Some lenders, some banks, make loans to political action committees. Is that allowed anymore? I'm not sure. It's making a loan. It could be construed as making a loan based on politics. There are just so many questions. But let's turn to you alluded to this subject of digital assets, and I want to turn to that because Congress very recently, with wide bipartisan support, enacted the Stablecoin Act, which is which deals with a type of crypto asset, one that is backed by Treasury securities, and it created a whole licensing infrastructure at the comptroller of the currency. There's a lot of worry out there among many banks that what they have created, maybe inadvertently, could lead to disintermediation, similar to what happened several years ago when money market mutual funds started doing business and paying a higher rate on money market mutual funds than the banks were paying very short-term assets. And so I'm wondering, Sean, how the forum members, how are they engaging, if any, with crypto? I know some of them, at least I won't mention the name, but one very prominent CEO a few years ago was very negative about crypto, but it seems like things may be shifting a little bit. What do you think?
So look, I cannot speak for the views of any of our particular members, but what I would say about crypto is the following. First thing is, again, largely with the changeover in administration, there has been a pretty significant pivot in the regulatory community effectively about the permissibility of engaging on crypto by regulated banks. So I think if you would look at the previous set of regulators, again, very high level characterization, which is subject to lots of qualifications, which we don't have the time here to get into. The basic tone was hands off. Not a good idea for you to be engaging in that kind of activity. And indeed, if you'd like to engage in that activity, why don't you call us up and ask us for permission beforehand? And, I don't know about you, but if you remember how you dealt with either your children or your parents, if your parents came to you and said, well, if you want to do that, you better ask me ahead of time, that kind of told you whether or not you're supposed to be doing it in the first place. So, and there's been a change, and there's been a change in this administration about that. And I would say, look, the world is learning about the utility and the value of crypto, whether it be stable coins or other things. And I have my own personal views on the utility of those things, which I won't waste anybody's time here spouting on this program. And I'm also not the arbiter of what's good or bad in the world. That's why we have markets, and that's why we have people. So it's going to get figured out. And so I think all of our members are, grappling with changes to the financial system as a result of crypto and thinking about where they're going to be. And different members have sort of different postures on that. And that will certainly evolve over time. I think our members, broadly speaking, they have a pretty simple ask on that, which is allow us, give us the authority and the flexibility effectively to be able to compete in the marketplace for those products and services. And to the extent that there is going to be a set of regulations, to which we have to comply to engage in that set of products and services, then they should be likewise applied to non-banks that are engaging in the same kinds of services. You mentioned the Stablecoin Act, or I think what we're calling the Genius Act. And I think one of the pillars of that regulation is that it effectively says, look, if we're going to have stablecoins, that's fine. Stablecoins are going to have to comply. When this was already mentioned in another context, stablecoins are, broadly speaking, going to have to comply with the same anti-money laundering and BSA requirements that banks have to. And I think that's totally appropriate. And there's been a lot of discussion over the last 3 or 4 years around, moving money between banks is so slow, don't you know? And it takes 3 or 4 days just to move money. There's a reason for that. And the reason is largely that our members are complying with the anti-money laundering requirements. And so if we're going to do that, then that should be done writ large. And so I think the main ask is effectively, regulatory parity, so that entities that are engaged in the same activity and the same risk face the same regulation.
Well, that, and specifically with respect to stablecoin, that stablecoin issuers should not be able to pay interest on stablecoin deposits that are made.
So the interest question is an interesting one. And what I would say about that, again, very narrowly, is if you think about what a stable coin is, a stable coin is effectively, from the perspective of an economist, a stable coin is private money. It is money that is being backed by a private entity that is largely used for transaction purposes. Now, the main thing that stable coins are being used to transact in right now are other stable coins or other crypto assets. But of course, as the economy evolves, that may change. And so in that regard, you should really think about stablecoin as being a replacement for cash in your wallet. And so if you look at cash in your wallet and you say, how much interest does that pay? The answer is zero. And the reason it pays zero is not because people are being mean or nefarious or they're trying to be bad actors. It's because the value in holding currency is the transaction value. That's why people hold currency. So the idea behind a stablecoin is that it's a digital means of currency that can be used to make purchases and sales and over kind of in the digital economy. So it's a replacement for cash. Well, we don't pay interest on cash, and so we don't pay interest on stablecoins. And then the final thing I'll say about stablecoins, right, which I, as an economist, I do think is historically relevant. It'll give people an inkling into my own personal views on this, but I won't go into great detail. The idea of a stablecoin is about 150 to 200 years old. So we used to have a banking system where banks issued their own private currency, and they backed them by the assets on their balance sheet. And that's the way the world worked before we had a national currency. And that was an experiment. We tried that out. And we don't have that experiment anymore. We have a fiat currency in the United States, and people can be of their own views as to why that happened and why history unfolded that way, not some other way. But I would say the idea of a stablecoin is some completely new technological innovation heretofore unknown to mankind, that's not accurate. There's a lot of historical precedent for stablecoin-like instruments, and that's been written about widely in the economics literature over the past several years. And I think that's an important perspective.
So let's turn to really a final topic, and it's deposit insurance. Wrapping up with a topic that seems to be getting a lot of attention recently, a push to increase deposit insurance. And at least some of the people think everything should be 100% insured. Can you briefly walk us through the historical context and what are some of the potential pitfalls of massively raising deposit insurance?
Yep. So great. And actually, this goes back to the historical discussion we were having, although for very different reasons. So look, deposit insurance is an absolutely, important, breakthrough public policy initiative that came in effectively after the Great Depression, which has been hugely consequential for Americans, families, households, but also in the collective, and I would suggest maybe even more importantly for the economy as a whole. So before we had deposit insurance, there was a lot more fragility in the banking system. And there was a lot more fragility in the banking system because the banking system really runs on confidence. And I think everybody instinctively knows that. And that was really front and center a lot more, in the early 20th century and in the 19th century, where the economy was subject to bank runs a lot more frequently than they are now. And the usual dynamic would be somebody would hear somewhere that, there was something going on at a bank, and it would be kind of a rumor. And then once somebody else heard that, they'd say, well, if there's something going on at that bank, surely I should just go take my deposit out of the bank. That will keep it safe. And if you start doing that and somebody sees you doing it, they say, hey, that's a good idea. I'm going to do that too. And then everybody lines up outside the bank, and bank can't survive if it has to give up all of its deposits. Why? Because those deposits are sitting in loans that have been made to companies, and your deposit is being used somewhere. So that will immediately basically bring a bank under and halt the financial system. And in the earliest 20th century, we were subject to lots of bouts of bank runs. And indeed, the Panic of 1907 was a huge bank run that was so devastating that the world decided we needed this thing called the Federal Reserve to stem the tide of bank runs. So flip forward 25 more years, we got the Great Depression. People figured out the Fed was not enough for a variety of reasons. We put in deposit insurance. Okay, great. Why do we have deposit insurance? We have deposit insurance to ensure that economy-wide, population-wide, we can instill confidence in the banking sector so that normal people, normal families living their daily lives, small businesses, that they don't have to worry about their bank basically getting cleaned out and getting drained by a bank run because their bank is insured and their deposit will be there no matter what. So there's just zero incentive for them to run the bank. And that has created a lot of stability and safety and strength in our banking system that has served our economy enormously well in the past, let's call it 100 years or so. But what that's about is about ensuring that small families and small businesses and people that aren't in the business of assessing sort of financial risk on an ongoing basis don't have a reason to worry about their bank. Deposit insurance was not put in place to ensure that large, sophisticated entities with extremely large deposits at banks don't mind the store, if you will. And indeed, we want those large depositors that have a lot at stake, that have a lot of skin in the game, to be minding the store, because that creates a lot of market discipline and it serves as a check on bank risk management and bank management to ensure that they act safely and soundly and with good intentions on the assets that they steward. And so that market discipline is extremely important. So if you have a deposit insurance scheme, which basically says everybody is insured up to some extremely high amount, let's call it, 10 million, 20 million, whatever it might be, you start to get to a point where, if you're a firm with a $10 million deposit at a bank, why should you tell your chief financial officer that they should spend any time assessing the risk management profile of that bank because you're insured? And that has disastrous incentive consequences that are both conceptually bad and theoretically bad and have been historically demonstrated to be a problem. So I think the best example of this would be the 1980s, 1990s S&L financial crisis. We closed several hundred banks in the United States over that decade. And there were a variety of causes to the S&L crisis, but one clear sort of leg of the stool in the S&L financial crisis was in 1980. For a variety of reasons, the FDIC increased the deposit insurance limit from 40,000 to 100,000. So that was 2.5x. That was a big increase. And economists that have looked at this over time, and the government, when they did their big postmortem report on the S&L crisis, came to the conclusion that the significant increase in deposit insurance really did erode incentives for larger, more sophisticated deposit holders to really discipline their bank. And so that's kind of the situation we're in today. And so, today the FDIC deposit limit is 250,000. It went up from 100,000 around the time of the financial crisis. It hasn't moved since, let's call it 2010. It's been 15 years. If people wanted to have a rational conversation around look, the economy's moved a lot in 15 years and a 250,000 deposit today is not what it was in 2010. It's a totally legitimate, reasonable conversation to have. But saying we want to raise the limit, to some enormous number like 10 million or 20 million per account, it's a bit of a head scratcher where you get a number like that. And B, it does raise some fundamental questions about what's going to happen to market discipline in the banking sector.
Yeah, the problem that I have with your argument, Sean, is that there are still a lot of financial institutions, depository institutions, that aren't publicly owned and aren't subject to SEC disclosure requirements that require the issuance of quarterly reports, an annual certified report. If certain developments occur, they have to file a Form 8K with the SEC. You have a lot of credit unions. You have privately owned banks. You have mutual savings and loan associations. There's still a lot of them, many, many hundreds, maybe more, I think more than 1,000. And it's very hard to get access. You can get call reports. Yeah, that's all public from the FDIC. But is that enough information for somebody to really make an informed judgment?
So, yeah. So I would submit that it is. And for anybody who's out there listening, pick your favorite small bank and go get their call report for the most recent quarter, and then spend an hour going through that call report. Now, it doesn't have everything in there, but you will find a wealth of information. And again, this goes back to our previous conversation. Banking is an extremely highly regulated industry for which there's lots of good reason. But one of the outputs of that high degree of regulation is an extreme level of detailed reporting on a quarterly basis on asset profile, liability profile, earnings, and so I think the disclosures that are required by regulators, whether it be the call report or if they're Fed regulated or whatever it might be, it might not be as much as SEC disclosure, certainly no 10Ks and 10Qs and that sort of thing, but boy, for a sophisticated entity that's got 10 million or 20 million bucks sitting at a mid-sized bank, at least the call report would provide a wealth of information for some pretty informed questions.
Okay, well, Scott, what do you think? You represent a lot of community banks. Do they favor deposit insurance reform?
First things first, I would agree with Dr. Campbell. I've never been concerned about where my deposits were at because I could look at the call report and know, on a regular cadence, is my bank safe? I think, post the Silicon Valley Bank failures, we did see migration deposits out of smaller community banks and up to super regional institutions and even to the globally significant institutions that Dr. Campbell works with. And so I think those smaller institutions probably would like to see some form of increase. Again, as was pointed out, it's been $250,000 limit for some time now. So they'd like to see some increase. I don't think they're looking for a super increase. And by the way, the question with deposit reform is always, well, who's going to pay for that deposit insurance, right? There are FDIC assessment fees. Are the assessment fees going to have to go up because the risk goes up? So I think we could see some desire for modest reform as opposed to, a huge increase in deposit insurance limits.
Yeah. To conclude by making an observation that I'd like to get a reaction from both of you about. It seems to me, the way I always look at how an industry is performing is I look at how does Wall Street look at the industry. And I find it very interesting right now that Wall Street, the stock market's hitting all-time highs, the Dow, the S&P, NASDAQ, going through the roof. They're infatuated with tech companies, particularly tech companies that focus on AI. Pretty soon it will be quantum computing. Then you've got the banking industry where all the indicia of what is good for banking, the metrics that you look at, it's a very favorable environment for banks right now. Interest rates have been coming down. They continue to come down. We're not seeing a lot of credit defaults. We're seeing all this deregulation, all the costs that banks had during the prior administration being lessened by what's been going on. But yet, Wall Street doesn't look at it the same way. They're not particularly excited about profitability in the banking industry. And what they're saying right now, and Wall Street always paints with a very broad brush. There were a few failures of auto finance companies, and some major banks are going to lose some money. Some of it involved fraud. And all of a sudden, Wall Street thinks, I think one CEO said, when there's one cockroach, that means there's got to be more. There's never just one. So I'm just wondering, both of you, first you, Sean, and then you, Scott, what's going on? Why is the banking industry still not viewed favorably on Wall Street?
So I'm happy to touch that one, but I'll begin by saying I really don't like sort of handicapping what the regulators will do, because surely you'll be wrong. That's actually second. I also never try and explain what the stock market is doing, because I think that's also a fraught exercise that economists don't have a particularly good track record with, me chief among them. Well, look, when I think about that, I think about two things, and this is partly tongue-in-cheek, which is a long time ago, somebody taught me that in the short run, the stock market is a voting machine, and in the long run, it's a weighing machine. And I don't know when you cross over between the short run and the long run. So I don't know if we're still in the short run period where it's just taking votes, or if it's really the fundamental value of banks has been fully reassessed by Wall Street. But I personally try not to spend too much time thinking about why the stock market is impounding this or that into the price of banks or any other security, because I think that what goes on there oftentimes defies any logical description, and that's just the nature of financial markets. So that's that. I mean, that's my basic view on that. I will say, some economists have looked at this, and at least there is some sense that the post-crisis regulatory framework has at least something to do with the depressed valuations in the banking sector, which is, if you think that the government and the regulators are effectively turning you into a utility, you could imagine how that might depress, your book to market.
Right. Scott, what's your reaction?
Yeah, I don't disagree. I mean, it seems like one of the things the market likes as much as earnings is growth, right? And by and large, because of regulatory capital and regulatory pressures, growth has been challenged for financial institutions. We have started to see some more larger institution combinations that may change the appetite of the investment community, and they might start picking potential winners to back. But the other thing is there still is an element of uncertainty, right? And we've seen, thankfully, a lot of regulatory burden ease already, and we expect more to come. But the question is how fleeting that is. Do we have a new administration in 28? And does the pendulum swing back the other way? And so when you're dealing with a regulated industry and you're considering investing in it, you've got to take a longer horizon and say, is what we're seeing now what we're going to continue to see or not? And that will, in some ways, warrant caution.
Right. I got it. Okay. Well, we've covered a lot of territory today, for sure. And I really want to thank you for taking the time and being on our program today. First of all, a lot of our listeners are probably hearing for the first time about the forum. They all know about the ABA and the CBA and the Independent Bankers Association. And I've got to admit that I was not familiar with the forum until recently, until we were introduced to one another. But again, thank you, Sean.
Thanks for having me. It was a great discussion. I really appreciate the opportunity. So thank you.
Yeah, and Scott, my thanks to you too for being, providing your insight, particularly with respect to the segment of the banking industry with which you are intimately familiar, namely community banks. So thank you, Scott.
You're very welcome. Happy to be a part of it.
Okay, and so to make sure you don't miss any of our future episodes, subscribe to our show on your favorite podcast platform, Apple, YouTube, Spotify, or wherever you listen. Don't forget to check out our blog, consumerfinancemonitor.com, for daily insights on the financial services industry. If you have any questions or suggestions for our show, please email us at podcast, that's singular, at ballardspar.com. Stay tuned each Thursday for a new episode of our show. Thank you for listening and have a very good day.